Good?
There, you're good to go.
All right, okay. A little bit of a learning curve for all of us here, that's for sure. So thanks for letting us sponsor. Insurica is proud to be a longtime member of CFMA and very supportive of all that we do for the industry. So I'm also happy to introduce Jared Asay, who's our presenter today. You know, and there's a lot of interesting things that you might already know about Jared. For example, he's a financial partner with the firm Conover Asay CPAs. They have a primary focus in construction accounting in the industry. And Jared also holds his CCIFP designation. His areas of expertise include reviews, audits, compilations, and contract schedule analysis. But did you know that Jared spent his early years as a professional framer for a custom home builder? Maybe, maybe not. Okay. I could also tell you, and maybe you already know, that Jared was a presenter at the 2018 CFMA annual conference, and he's also been an author for our magazine, Building Profits, and also for Construction Executive magazine. But did you know that Jared was actually planning to deliver today's presentation as a part of the 2020 National Exhibition in Washington, D.C. So we hope that we're a good audience for you today in its place. Jared, I know you've been preparing for a long time for that. Jared's been involved with CFMA since 2005. He's served as secretary and board member for our local Valley of the Sun chapter, and he's chaired multiple committees. He's also involved in the Surety Association of Arizona, where he was our past treasurer, and also with the Arizona Utility Contractors Association, where he's currently a board member. All of this certainly confirms that, that Jared's a highly qualified professional in his field. But if you're familiar with Jared at all, I don't have to tell you that he's highly personable and a real pleasure to know. So with that said, I'll yield the screen to Jared Asay for his presentation, Preparing for the Worst, Planning for the Best. Thanks, Jared.
I'll take that for the better. I've got some experience, I guess, getting there under my belt. During the quarantine, I guess, people were calling me Santa Claus because I let my beard grow out, and it was all white, so shaved it for this presentation for you guys. So assuming that everybody can see my screen, let me just check the audience view here. It looks like that's the case. We'll go ahead and get started. So yeah, like Debbie said, I was planning on giving this in Washington, D.C. a couple weeks ago. Gratefully, I'm glad that we talked with Lindsay Benson and the programs committee that they didn't want this to go to waste, and I'm happy that it's not. And so hopefully today it'll be worth your time and worth all of our time, that everybody can take something home today that they take back to their companies, that they can implement if they haven't already. I'm sure there's some of these things that you already have implemented in your companies, which is great. But I'm hopeful that there's a few things that maybe make you think about taking back to your companies. So also, I've got some, during my presentation, I'll get some audience interaction. We've got some poll questions that we're going to use today. So if you could use those and please participate in those. Looks like we've got about 59 participants so far, attendees so far, and hopefully that grows. And I think we've got about 75 that were scheduled to attend. And so we'd like to use that to some extent as far as CPE and attendance to make sure that everybody's participating, and also it's good information. So hopefully we've got some good polls that we can share some of that information with each other. So with that, the title of the Washington, D.C. Conference was Foresight is 2020. And I know the more common phrase maybe is hindsight is 2020, but the whole point of this is to try and look ahead, right? And so, yep, obviously we know what's going to happen in the past. We as CPAs and accountants, we have that good or bad mantra or whatnot of reporting on historical events, right? But the fun starts when we're able to look ahead and use that historical data and okay, well, what did we do last month? What did we do last year? Let's look ahead and how can that impact going forward? And so, the quote here by Benjamin Franklin, by failing to prepare, you are preparing to fail. So that was just the whole point of this presentation that we'll go through today is how can we help our companies be more prepared? What are some of those things that we need to look out for? What are some metrics that we need to look for in going forward? So as an introduction, I know this is the agenda, obviously, the things we're going to go through today. Give a quick introduction. We'll look back, to pre-Great Recession times. I know that seems like so far ago, but we'll take a quick look back there before we can move forward. We'll look at some best practices, what it takes, some things that I've seen in some of my clients that they've implemented that have really impacted their companies, and then obviously we'll go through a summary of what we've talked about. So as an introduction, Debbie mentioned that I used to be a professional home builder, custom homes, and that was through my high school days and through my college days, and it was a great time in my life, and I loved it. It's been good now in that my wife knows of those skills, and so I've done some things around the home, which I like to do, but now I've added to my honey-do list because of that history that passed. But one of the great, if I can for a minute, share a great story that I had with one of my mentors, my boss, the owner of that construction company. Me and his son, about the same age, and any of you that have dealt with construction know the proper use of a hammer, right? And so I did not at that time know the proper use of a hammer. I don't know if I was 16, 17 or whatever. And so what I was doing, hopefully you guys can see this. I can't see my screen. So when I would use the hammer, and this is actually that same hammer that I was using, a 16-ounce hammer that's about 25 years old. And so what I was doing is I was having my arm be rigid, and I was using the whole thing instead of having the hammer, using my wrist and letting the hammer do the work. He made me and his son nail off by hand with a hammer and nails an entire deck, the roof decking of a custom home, about a 6,000 square foot home that had different roof cuts in it. And so it took us about 2 days to hammer that entire roof, but with the proper technique and not being rigid, not being stuck to use this tool the way that I shouldn't be using it, but letting the tool work for itself. Was a great analogy in my life, and I love that lesson that he taught me. And so we're going to use that today. What are the tools that we're using, and are we using them the right way? We have this information, we have this data, but are we using it the same way? Let's look at it a little bit differently. What is something that we can take back to look at it with a fresh mind and have those tools that we have at our disposal and use them a little bit differently and better for the benefit of our companies. So Anirban Basu, most of you, those of you that are CFMA members know Anirban very well. And so he had this quote, many CFOs, along with many economists, suspect that the risks of recession are elevated in 2020. Now, the unique thing is that he brought this up in September of 2019, which is about when everybody's probably going gangbusters, the economy's going great. And so when he brought that up, you're like, okay, it's going great, but eventually it's going to end, right? When will it end? And so at some point by the end of 2020 was his thoughts. We obviously didn't know about the pandemic that was going to happen. And so now it's kind of been accelerated, right, as far as the recession or a dip in the economy. And so now what are we going to do regarding that? So with that, let's get to our first poll question. Stephanie, if you want to put that up. So prior to COVID-19, did your company proactively address responses to an impending economic downturn? So were you ready? Did it surprise you? Did you have those things already in place? Was your company already discussing, hey, let's put some cash away. Let's make sure we're meeting on a regular basis to go over these reports, and let's keep an eye on those things, those trends that we see. And if we start to take a dip, maybe we peel back on our administrative costs. Maybe we peel back on purchasing of equipment and those types of things. So did your company proactively address responses to an impending economic downturn? But this is before COVID-19. So let's see if I can see the polls here. We'll keep that open for a minute. Stephanie, I'm not seeing the poll results.
So we've got 78% voted so far, 80% now, and we have 34% yes, 66% no. So the majority of them are no.
Okay, great. We can go ahead and close the poll then. So good. Well, good and bad, right? So maybe that's why you're on the call today, to see how you can be more proactive in going forward. And so maybe there's something that you can bring home to your companies, bring back to your company. So those of you that have, I think you said 34% that have, that's great, right? That you're already being proactive and looking ahead to those types of things, because we don't know, right? We didn't know that COVID-19 was going to happen. You don't know. We don't know exactly when a downturn in the economy, a stock market crash, a lost job that's going to happen, right? We try not to have any of those types of things. Key employee leave, right? We're not in control of a lot of those things, but we are in control of certain things, and so we can help ourselves plan for that. So that's great. Thanks for participation. So let's go back, right? Let's go back a little bit back to 2007, winter of 2007, winter of 2008. So about 12 years ago, things were going great, right? Right before this recession hits, the Great Recession. And so what's going on then? Well, the Apple iPhone, just kind of for some perspective here, the Apple iPhone had just come out, right? So right now, everybody has smartphones. The Toyota Camry was the best-selling car, which is a very practical, very conservative car. I would assume in the chat, we could probably put in the chat room or whatever, how many people still have a 2007 Toyota Camry, which is great because they last forever, and that's probably a very typical car for this audience, including myself. George W. was our president. That seems like forever ago today. Justin Bieber wasn't even famous, right, back then. His new album had just come out. And then the best part of this time was in February of 2008, when the catch happened and David Tyree caught that helmet catch and upended the, at the time, undefeated New England Patriots. Now, those of you that know me, one more thing, Debbie, about me is that I'm an avid Indiana. I went to Indiana University. I'm an avid Indianapolis Colts fan, Indiana Hoosiers, right? That's my passion. And so the year before, the Colts had won the Super Bowl, ecstatic, right? So many years of bad teams. I might have been more excited to see the Patriots lose than to have my Colts win. So I'll just leave that there. So now, another quick poll question. As far as the Great Recession, right? Getting into that Great Recession. So that was happening, but before that, all these things in 2007, 2008, put us back to that time. So now we're getting through the recession. So what was the most impactful decision that your management team made during the Great Recession that allowed continued success? So here's 4 examples here, and anything else that you guys have done that's not listed here. So maybe what you did is, hey, you know, things aren't looking good. Let's reduce our overhead. Let's kind of peel back that a little bit. Or maybe right before the recession, things are going great. You'd moved to and did some operations in New Mexico or Nevada, or from doing just pure construction work, you started to do service work. Maybe now after the recession, okay, now let's go back to our core business. Did you do proactive planning? Was that something that you were constantly on top of and having regular meetings with your PMs, with your management teams? Were you more on top of people, making sure that you held them accountable for their actions, especially the people out in the field, which drives your activity? So or other, right? So the things so go ahead, Stephanie, go ahead and open up that poll if it's not already.
Yeah, it's open.
It's open?
Yeah, we've got 73% voting, and it looks like you've got the majority of them with 44% reduction of overhead, followed by return to core business at 27%, and then proactive planning and other. You got 11% of other, but it looks like it's going from top to bottom as far as the most responses.
Okay, great. So the most of the respondents reduction of overhead, which is an easy, right? Which was a fairly easy thing to do. Sometimes that's a hard conversation because a lot of that's probably payroll, right? And then having to reduce having instead of 3 people doing the job of 2, coming back to 2 people. Those are hard discussions, but usually the better for everyone involved. Returning to the core business, you said 27%. That's great. One of the things that, before we move off this slide, the things that aren't listed here that I didn't list are what I call band-aids, right, or temporary fixes, which would be capital infusion, right, from the owners, which would have maybe it happened with a lot of your companies. If they didn't have the resources inside the company that you didn't keep enough cash on hand, that hey, owner, we need to have you to infuse more capital into the company. That's a temporary fix, right? That's not a long-term plan for sustained growth. Or selling equipment is another thing, right, that I didn't put on there, because that's really more of a temporary thing. Sure, it can create cash flow. If you had excess equipment, you don't want them sitting idle. But we'll get into the better scenario. Instead of selling equipment, there's another option that we'll talk about later. So great, thank you for your participation there. So now we'll jump into some best practices. So I've got 3 listed here, and we'll kind of dive into each 3 of these pretty deep. And so the first one I got listed, timely and accurate financial reporting, huge, critical, right? It's obviously the area that we're all in as far as financial reporting and accounting and CPAs. And so it's important, it's imperative, as we all know, to the companies that you work with, especially with construction companies, to have those contract schedules tied back. Do you get them timely? Are you waiting 3 weeks or 3 months rather to get your contract schedules in? And so that you know how you did 3 months ago, it's like, whoa, wait, this is a lost job. And now you got 3 months already into that job again. And so if you knew it within 3 weeks, then you're like, okay, well, now we can make some change instead of having 3 months go by without change. Having this concept of a flexible balance sheet, we'll walk you through that. Dedicated project management, which I've kind of alluded to a little bit, having your PMs, held them accountable. There's some definitely best practices there. And then we'll walk through an example, a simple example of a sample construction company that hopefully will help solidify some of these concepts. So regarding financial reporting, so there's a couple of different things, right? So financial reporting, that encompasses a lot. So the first one is internal monthly reporting. So hopefully each of your companies are reporting on a monthly basis internally to your management team, including your PMs, including obviously the owners and the CFOs, the controllers, the operations guys, and so those and gals. And so that internal reporting, monthly reporting is critical. So if those aren't happening on a monthly basis, let's make sure that happens. I've got another poll question here related to that coming up. And then sharing financial results. Do you share those financial results, or do you print them, leave them in your drawer, and they aren't seen, right? And there's your historical piece to it, right? But the whole thing is to use that data and use it to make change going forward. And then annual financial statements. Well, we'll talk through, and that's the example that we'll go through on the annual side, on an annual basis for your sureties and banks and the users. So diving deeper into internal monthly reporting. So this should include your contract schedules. It should include estimates, right? So you don't have to have all that information. Say, oh, I didn't prepare those monthly reports and the balance sheet and income statement because we don't have all of the bills back from our subs, or I don't have payroll. Payroll didn't get paid until a couple weeks after, based on the timing, if they get paid on a 2-week basis or whatever. Most of the time it's weekly basis. So there are vacation accruals, certain accruals, whatever, but use estimates, right? So the internal monthly reporting, you know what your typical run is on a monthly basis, and so incorporate estimates. You don't have to wait until 2 months later when all of the bills are in. Use some of, hey, we know we've got these coming in because we've been corresponding with the subs. We know the expenses and the accruals that we have, and so incorporate those estimates. Don't let the not having the absolute accurate numbers delay the monthly reporting aspect. And then you take those monthly reporting and you compare it to your budget. Hopefully your companies are creating budgets and some cash flow analysis and some projections. And so, okay, well, here's where we thought we were going to be. Are we close? How does it look? And so otherwise, okay, here's these numbers, but what do they mean, right? So when you put out budgets and you compare those two, okay, well, here's where we thought we were, either we're below or under. What does that mean? Let's have some dialogue and let's find out how we can do better next month, or keep that same level the next month. Having a dashboard. This is, you guys probably all have this, maybe call it something different, but something that you're looking at on a regular basis. I don't know if that's daily, if it's weekly, if it's monthly, but having those dashboard of those key metrics that you guys look at. And so what are those? What are those things that your company looks at? Because each company looks at something different, right? Depending on if it's a general contractor, if it's a subcontractor, whatever company industry that you're in, there's different metrics that you look at based on where you're at this point in time. And so do you have those readily available, or are they easily trackable and updated? So here's a list of 3 questions that I like to pose to a lot of our clients to kind of help them kind of look inside, right? To kind of look in the mirror. And so, like we've just mentioned, so what are some of the key ratios and metrics during the company's most successful period, and how does that compare to current results? So not only just the budget, right? So we've got this budget that you want to compare to, but now if we look back again, back when George W. was the president, and back when the Patriots lost so amazingly, how did the company look then, right? So what was the ratios and metrics then, right? That's a good metric too, because probably you were looking pretty good. A lot of the economy was booming. That was a good time for a lot of companies. And so going back 12 years, what did we look like then? How do we look like now, right? Are we still kind of trying to get our equity back up into those levels? Are we still trying to get our cash reserves up into those levels? And so comparing that, or maybe not even then, or to the most successful period of time of the company. So that's a question to look at. The next one is the current financial strength of the company enough to outlast another prolonged recession without relying on outside resources. So like I mentioned, one of the options, one of the band-aids was to have a capital infusion by the ownership. And so if they're depleted of that infusion, the ability to infuse any more money, are we leaving enough money in the company, or is the company making enough money and leaving those resources in the company to outlast another prolonged recession? So hopefully that's the case. And I back to the original question, looks like there's about 60% of you or so, 2/3 that may not be in that position. So that's a goal then that maybe you can set. And then the last one, when is the right time to make capital improvement investments to stay at the forefront of technology? Technology is huge. I'm all about efficiency, right? What is the best way to improve efficiencies by use of technology? If that's the way that your people in the field report their payroll, if it's the way that you're monitoring jobs, if it's investing in your accounting system to get an upgrade so that you can track and have better reports in one system instead of multiple systems, it just creates efficiencies. As far as sharing financial results, I've talked in the past about this 3-legged stool concept, right? So it's having the accounting department, the operations department, and then the bidding department, those that bid, they're all talking together, right? So you don't want to have, like I said, the accounting department have the results of what happened in the first quarter, and then they don't share that with anyone. What should happen is, hey, here's the results of the first quarter. Let me send that over to operations. This will look right to what's going on the field. Does this seem right as far as the receivables and the collections and the costs, these jobs, the percentages, the gross profit percentages, are they all matched up with your expectations? And then, especially with closed jobs, right? So if those jobs close at 20% margin, but then all of a sudden the bidding department or your bidding personnel, they're bidding still jobs at 15% or whatever, then you're like, okay, well, wait a minute, maybe we need to change the way that we're bidding because our jobs are ending a little bit higher or they're ending a little bit lower, the way that they're finishing. So making sure that they're not bidding based on 2 years ago information. Hey, wait, our costs are going up. We've got insurance costs going up. Our margins are going down. We got to incorporate this into our bids. Otherwise, a year from now or whenever those jobs close that they just bid on now, on 2 years of information ago, then you're going to have another a year or 6 months or whatever of those jobs closing at a lower gross profit percentage. So it's important that everybody's talking about those financial results for their different purposes. Another good thing to share and to compare your results is with the CFMA financial benchmarker. So if you haven't participated in that before, I believe the 2019 information, I think the deadline was Monday, June 15th. So hopefully most of you are able to get your information in there. If you put your information, I think it takes about a half an hour for you to load that information, your 2019 financial results. It takes about a half an hour, but you get the benefit as you receive detailed results of your peers, peer group analysis, the location here nationally, the same industry, and NAICS codes and all that. And so it's a good resource to compare to your peers and see how you're doing. And like I mentioned before, also great to compare against 2007 to go back a few years. So we'll dive into this example of this annual financial statements that I put together. So one of the things, obviously, is to have a construction-focused CPA. If you're a construction firm, then you should have a construction-focused, or a construction company, you should have a construction-focused CPA firm. Accounting is accounting, right? So there's debits and credits, there's receivables, and there's revenues. There's some nuances with construction that make it important to have a construction-focused CPA. And I know there's some sureties and banks on the line now, and so I'm sure that they would concur with that they like to see those the review report or the audit report from a construction-focused CPA. So that's something to think about if you don't have that yet. And then we're going to dive in to some of the numbers, and here's some ideas for maximizing bondability. So even if you're not bonded, even if you don't have bonding needs, this bondability concept, just think about that as becoming more financially strong, right? To qualify for additional credit with the bank, maximizing bondability. So it's just good metrics for you, for construction companies to go through to create a more financially stable company. And so we'll walk through these 5 things, some intangibles, not goodwill, but more like, when are the financial statements done? Are you truthful and honest and open with your surety and banker and the users of your financials? Do the year-end results rep consistently with your monthly reporting that you've provided, or are they very different based on adjustments that the CPA proposed? Depreciation I'll talk about, related party activity, lines of credit, and some distributions. So here's an example of an independent accountant's review report. So this is the Sample Construction Company, Inc. Example that we'll go through. So this is just your standard review report, but at the very bottom, the last two lines, right? So this first one is a review report. It looks fine, and it was provided by generalist CPAs, and it was dated June 30th, 2020. So if we can think that June 30, 2020 was much different than December 31st, 2019, we're correct, right? Obviously with the pandemic and everything that's going on socially. So it's a much different world 6 months later, right? So it could be a little stale, right? And so I'm sure with these financial statements, the surety of the bank would ask, okay, thanks for providing the year end, but can I also get first quarter now? Something a little bit more timely. And so it's much different than this one, right? So this is the same report, but now it's signed by a construction specialist, CPA, and it's dated 1 month after the year end. And so that tells a lot, right? Now, here's your intangible, right? To that surety, to the banker, to the user of your financial statement, okay, this company recognizes the importance of the accounting aspect and having somebody with not construction knowledge, that they're the ones that are reviewing these financial statements. Oh, and look, it was done within 4.5 weeks, right? A month of year end. And so they're very timely. There's not additional reports that we can provide because there's none to provide because it's very timely. And so that's just a benefit, an intangible benefit to your companies. With that, let's go back to the monthly basis, right? So January 31st is a good, that's very quick, right? Within a month to have your financial statement dated, and we were able to do that for a few of our clients in January, which was great. I think we had the most in January this year than we had in any other year. And so going back to your monthly close though, because on the annual basis, we know it's going to take a little bit longer. You should hold those open a little bit longer just to make sure that you've got all of the good numbers in there. It's a little more accurate. But on a monthly basis, your internal close, I'm just curious to see what everybody's thoughts are, what everybody does, what their policies are, and how consistent they are with. Is it less than 15 days, your monthly close? Is it between 15 to 30, between 30 and 60, or is it more than 60 days? So I'm just curious. Again, this does not include the year-end close, but I'm anxious to see what your monthly internal close is. Got that open, Stephanie?
I do, and we have a 62% votes in. We've got a 56%, which is the majority, between 15 and 30 days, followed by 24% where they're noting less than 15 days.
Okay. Are there any that were more than 60 days?
No. Actually, yeah, they're 3%, more than 60 days. Yeah.
Okay, maybe one. Maybe
yeah.
one. Okay. Well, good. So between 15 and 30 days, that's not bad. That's actually not bad at all. And so the quicker, just the whole point is, the quicker that you can get it done, the more soon you are to have that data, right? I love data. You can have too much data, right? But as far as if you have too much, then you really can't analyze all of it as appropriately as you should. But to have it timely is even more critical. Having the right data and having it timely for you to make decisions like we've talked about, some changes. So if you have it within 15, 20, 25 days, that's a job that hasn't gone on too long before you can make some change. And so that's great. That's good to hear. All right, we can close the poll if you haven't already. So here we're going to get into an example, simple example. Hope you guys can follow me. Let me move my screen here so I can see some numbers. So this is a balance sheet, a simple balance sheet of a sample construction company, Inc. And this is before maximizing bondability, right? So he's got some things in here that we're going to take a look at, and I'll highlight them as we go through, and hopefully you can follow. And so we'll go through a couple of examples of some things that if you have these on your balance sheet, this is what, some intangible benefits, some financial benefits of having making some of these changes to your financial statement. So the first one, if we look at that due from related party. So right now you can see that we've got $100,000 due from either the owner, a related company, a rental company that's related, or whatnot, right? Let's say that related party receivable was either collected or we didn't have it to begin with. What happens? Well, now we've got $600,000 of cash up from $500,000, and we have zero due from related party. So it doesn't change the total current assets on this particular financial statement from a formal presentation standpoint, because sure, that due from related party, if we had it in the current section, if the related party was supposed to have given it within the next 12 months, we would include that in the current assets. But we know, and I'm sure the sureties that are on here and the bankers here, that they would discount that related party receivable anyway, right? And they would assume, I don't know, 100% allowance on that receivable and have that down to zero for their purposes anyway, right? Oh, it's related party, they're not going to collect on it, so we're just going to exclude that altogether, not give them credit, not give them working capital for that. And so it's just good just to get that off the books formally, right? So just have either minimize that related party activity, make sure we get that paid back sooner than later, so that it becomes cash in the company, and we don't have to have those questions to ask of the surety or the banker. The next one, if we look at property and equipment, we've got $290,000 of net book value of property and equipment. We've got $800,000 of stockholders' equity. And so what happens is sometimes we have clients that will depreciate their assets too quick, right? So they'll have 5-year assets on trucks, right? On a Ford F-350, they'll have a 5-year life on it, but we know those diesel engines will last 7-10 years, 200, 300, 400,000 miles, right? And they've also got another F-Ford 350 that was purchased in 2010, and it's still working out in the field, and it's 2020, right? So maybe a 10-year life would be more appropriate instead of 5 years, allocating all of that cost of that piece of equipment to 5 years. Well, let's spread that out. And so here I've assumed that we've helped our clients spread that out, that estimate, and that they've been able to expand and allocate those expenses over a longer period. And so equity, say that difference was $50,000. So equity goes up $50,000 because that's $50,000 of depreciation expense that may not have been recorded in the past. It would need to be recorded in the future as those assets depreciate. And then the value of the assets goes up $50,000. So there's a small piece there that can help your assets and your equity. The next one is the line of credit. So if we look at that line of credit on the right side, $200,000 line of credit they have available, and look at that, it's fully maxed out. $200,000 is outstanding. So in the past, or kind of background information, we find out that this $200,000 had been outstanding on this line of credit for a couple of years straight. Well, that's not really what a line of credit is for, right? It's supposed to be a temporary account for retentions when those are going to be received. And so that $200,000 really isn't doing what its purpose is, to be in and out of this line of credit. It's really more of a term note, right? And so we go back to the bank and we say, hey, let's just go ahead and term out this $200,000 line of credit. We're not using the way that it should be, so let's pull that down below the line as a long-term debt. Now, however, let's just call it a 5-year loan. And so that 5-year, let's just assume that 1/5, it's going to be paid in regular equal installments over 5 years. No, that's not the case, but just for simplicity purposes, the current portion, you can see that current portion goes up from $100,000 to $140,000 goes up $40,000, and the remaining $160,000 is increased to the line of credit. And so the note payable goes away, 160 goes below the line. That increases decreases our total current liabilities. You can see that goes from 1.3 of total current liabilities now down to 1.14 just by terming out a line of credit. That's huge, and that's significant. That's called having that relationship with your bank to let them know, hey, here's our thoughts, here's our plan, and can we just term this out, and it'll help you financially, knowing that you've got consistent payments, and that a significant portion of that, in this case 4/5 of that, is going to be included below that line for liabilities. Another example of potentially increasing the financial strength of the company is assuming that this company had $100,000 of other lifestyle distributions that were paid out to the owner, right? So you can see stockholders' equity right here is $850,000, but let's say that $100,000 of distributions, lifestyle distributions that were paid, and granted, the owner has the right to take out his money. This is his and her money, right? This is their company. They put their blood and sweat into it. They have all the risk, right? And so we're not saying that shouldn't happen. If the goal was to increase the bondability, increase the financial strength of the company, then maybe we keep that money in the company. So let's say that's $100,000. That increases cash, $100,000 from 600 to 700, and it increases stockholders' equity from 850 to 950. You see that? So here's before terming out, or excuse me, the strategic distributions, and now cash is up to $700,000. It increases current assets up to 2.2. Again, working capital is going up. And then the last one I want to walk through is, let's say we had a lost job. So if we had a provision for loss in that contract liabilities line, that $600,000 in the current liabilities section, let's just say included in that was a $50,000 provision for loss on a job that ended up not making us money, but we ended up buying, right? So that would end up being negative gross profit. It's $50,000. So that $600,000 goes down to $550,000 if we remove that $50,000 provision for loss, and now equity goes up from $950 to $1 million. And so those are a few examples of what you can do to help your bonding capacity, help your financial strength of the company, your credit ability with the bank. And so if we go back to the beginning, this is that original slide. Here's the before maximizing bondability. This is the company before we made all those changes. So you can see $2.1 million, 1.3 of current liabilities, so $800,000 of working capital, $800,000 of equity. And now we increase those items that we've talked about. Working capital is now over 1.1 million, and stockholders' equity is at $1 million. And so here it is in a different format. A couple other things that we look at is liabilities to equity. I know banks are keen on those types of metrics, and so it's one that we look at as well with our clients. And so before maximization, you can see that the liabilities to equity was 2 to 1, meaning that you had $2 of a liability compared to $1 of equity, and which is not bad, right? I think most of the bankers, if there's any on the call, would say that that's really that shows that it's a strong company. So it's not like it wasn't a strong company to have that high of a liability to equity ratio. But now we reduce that even more, right? After maximization, now liabilities to equity is now down to 1.5 to 1, right? So that's just, you're not relying on outside sources as much as you are previously. So there's that change in equity as well. And then that bottom section, so the results, right? So what does this mean, right? So now I've got some good numbers, working capital is up, my metrics are where they should be, going the right way. So you have increased cash flow, right? Now you've gone from what, $600,000 to $800,000 of cash flow. So that's, cash is king, as we know. You've increased your bonding capacity. You've increased the credit, your credit ability with your banks and lenders. And then at the bottom line, we've just increased equity and net income. So that's the whole point of being in business. So hopefully that was some good nuggets for you. Let's go to our next poll question. So which financial area or metric is most important to your business? Now I know you have a ton of metrics or financial areas that you kind of key in on, but I've broken them down to these 4 and then kind of another other section for everything else. And so we've got cash, listed. I've got working capital, I've got debt reduction or financial results. And so cash meaning, is it the cash flow? From a collection standpoint, are you taking advantage of all your discounts? Is that something that you track daily, right? If you look at it, if you get a cash sheet on a daily basis, maybe that's it. That you just track the cash in the bank, and that's kind of how you track your company. Is it working capital? Hey, where's our working capital at this month? Is it debt reduction? Is it trying to get to the point, hey, you know, we want to be less reliant on the banks. Let's just try and pay off these debts, and let's convert that into equity in essence as you earn income. So is debt reduction, is that something that you guys are looking at? Or is it just purely financial results, knowing that those financial results, holding PMs accountable, allocating your indirect costs properly, getting that net income percentage up where it should be, is that obviously drives a lot of these things, right? So if you have good financial results, hopefully you're getting paid by your customers, and so cash is going to increase anyway, right? Working capital is going to increase, and hopefully debt, then you can pay off debt. So how are we looking, Stephanie?
Yeah, you were right. Cash is king, 54%, the majority for cash. And then it's followed by financial results at 24%, followed by working capital at 10%, and then 8% for other.
Okay. Good. No, that's perfect. That's good to know. So that's right in line with my thoughts, and like what I was saying, financial results, 24%, that really drives that cash perspective, right? So I know you're not just sitting there managing cash, watching your cash balance, but it's a matter of managing it as far as, okay, how do we, what payments are we going to make this week on our accounts payable? What discounts can we take advantage of? So that's great. Thank you. Actually, let me go back here. So one of the things I want to bring up too, no, hold that thought. I'll bring that up in a minute. So annual financial statements. So as we continue on that theme, right? So the financial statements are done. We've kind of helped and talked with our CPA and with our consultants about how to increase the presentation, make it look better, make them look stronger, right? From if we've done those things, those 4 or 5 things that we've talked about. So now what, right? So we've got proactive tax planning is something that you should look at, and that helps as well from a financial statement standpoint too. So assuming that most of your companies are flow-through entities, then you've got there's tax money, even though the company itself doesn't pay the tax, that flows through to the owner. And how does the owner pay for that? Usually with distributions out through the company, right? So indirectly, the company is paying that tax through distributions, not through a provision or through expense, but through distribution. So it's important to correlate that and to plan that proactively. A couple of things, that benefits of doing that. One is that you will know the tax liability months in advance. So if you're doing tax planning back in the fall, using the third quarter numbers, if you're calendar year end, October, November, you're looking at that, sitting down. Okay, yep, here's where we think that fourth quarter is going to be. Here's where we think we're going to end up at the end of the year. Okay, well, based on last year, based on the results, based on the tax codes and the new changes to the tax law, here's where we think that liability is going to be. So you're going to know, if you're doing proper tax planning, in November, December at the latest, what's going to be owed, well, in April or on July 15th. I wouldn't plan on next year's being July 15th deadline, but the tax payments normally are due April 15th. But you would know that months in advance. And then also making sure that you coordinate your tax and financial planning at the same time. So instead of saying, oh yeah, we want to save a ton of tax, let's just pay down all these payables, let's just deplete all of our cash, we'll pay all that tax off. And then you get to your financials at the end of the year and you have no cash. We've been talking about cash is king. 54% of you look at your cash balances, and then all of a sudden your surety looks at that and sees a zero balance on your cash because you've used it all to save on taxes. Oh wait, hold on. Now this doesn't look right either, because now that cash balance isn't very good. Where are you going to get those funds to pay down the remaining payables? And so it's important to look at those together and in a cohesive manner, instead of with blinders on one and the other. It's also important to be farsighted in your tax planning. So instead of saying, yep, I don't want to pay any tax this year, okay, I'm sure your CPA can find a way to do that, to accelerate payments, especially if you're a cash basis taxpayer. Let's just accelerate all the payments today. You're not going to pay any tax this year. Well, guess what? And also by taking depreciation, let's just take all the bonus depreciation this year. Yep, no tax paid this year. Now next year we come fast forward 12 months. Well, all those deductions that we could have used in January, instead of using them in January, we used them all in December, so we don't have that month's worth of deductions. Oh, and we didn't buy any new equipment this year, so we have no more additional bonus depreciation to take on additional equipment. So now we have to pay all the tax this year with minimal deductions. And even worse, you grew as a company, and now you're in a higher tax bracket. So now you paid more tax in that second year, when you could have paid a little more tax in the first year at a lower tax bracket and paying a little less tax at a higher tax bracket to stay in that tax bracket where you normally are, instead of going up to a higher tax bracket, staying down and managing those costs and being proactive on when do we pay these costs, when do we take this accelerated depreciation. So that's something to think about too, being farsighted in your proactive tax planning. So I mentioned this flexible balance sheet earlier, and so we'll walk into what that concept means. And so a couple of things on your balance sheet. You know, you have equipment and that fixed assets. We walked through that in the example a little bit. We know that there's partners. We know that there's some cash flow issues as well. And so what does that mean to be flexible then? So how can my equipment be flexible in your partners and whatnot? So let's walk through the equipment first. And so the biggest thing that we see, especially with a equipment intensive construction company, is what you want to do is you want to maximize those utilization rates, right? I'm not telling you anything that you haven't heard before. And so as you maximize those utilization rates, meaning that those backhoes and those earth movers are not sitting in your yard, they're actually out earning the money, the company money, right? So that those utilization rates are so high that it's just always generating. Where's the next location that it's going? And so that job, that piece of equipment is going to the next job. It's not coming back to the yard. It's going directly back to that next job. And that those PMs are certain things, right? So that PM that has that, it knows that if that piece of equipment is on their job, they're getting charged for that piece of equipment. So number one, they have an incentive to move that equipment to another PM or to another job that needs it, and to get it off his job, so that his gross profit looks better at the end of the day. But the whole point is just to maximize that utilization rate. The other concept is this owned versus leased concept. I've had multiple conversations, actually even one this morning with a client regarding leased versus owned equipment. And so the concept being, do I own all of my equipment? Do I lease all of my equipment? Is a combination of both. So there's benefits, obviously, with all three, right? So when you own equipment and you have somebody on hand that's a mechanic and can take care of it, and you've got good maintenance on those jobs, are going to last a long time. And towards the end of the life of those assets, like I mentioned, that F-150 that's going to last forever, well, then maybe you start recouping some of those costs that you've put into it, right? So there's some value there, right? To have owned equipment, you own it, and here's your base listing of large equipment that you can use and make sure it's utilized. But then on the other side, you've got an opportunity to lease equipment, right? And so leasing, maybe it's a higher rate, right? Because you don't have to worry about the maintenance, perhaps, right? If it breaks, you call somebody else to have them come and fix it, right? The lessor. And so those types of things, they can swap it out. And so there's minimal risk, but you pay a little bit higher rate for it, right? On a monthly basis. So our conversations we have with our clients is to have a good mix between the two. You want to have that base where you know that the company's been historically, right? You know that, yep, we've owned, this is our main fleet, no matter in the good and the bad times. This is our main fleet that we have. It's 5 trucks and it's 10 large pieces of equipment, right? But in the good times, we start ramping up, and now maybe we go up to 8 or 9 trucks and 15 or 20 pieces of equipment. But if we know the history will, will repeat itself, and that potentially the economy will start to come back and peel back a little bit and correct itself. Well, if I own all that equipment, nobody wants to buy equipment, right? When times are going down, nobody needs that equipment. So that's why it's good to have that lease, that accordion effect. Okay, I'm going to lease this amount of equipment, and then once the economy starts to come back, well, then I can just not renew that lease after that job, because I leased it for a short term, 6 months for that backhoe, and I know that I'm going to need it on this job. I may not need it after unless I get a similar job. And so as soon as that job's done, you don't have a similar job, that lease is terminated. Now you have more cash, right, opened up that following month, because you don't have that lease anymore, and now you don't have an asset that's not being underutilized. And so that's a huge boon, I think, to our clients in those conversations that we have, to make sure and to have that conversation and to look at, well, is this going to be something that we can use on multiple jobs for multiple years? And is it going to be worth owning it, or do we lease it, pay a little bit more, and then we get rid of it, give it back after that job is done? We've already talked about the depreciable lives and the salvage values. There's so many new clients that we get that don't utilize the salvage value option. And so what that means is, at the end of the life, like we mentioned, this is, take that F-150, for example, excuse me, F-350, right? So even at 5-year life, the 5-year life may not be appropriate, but we've seen new clients come in, and the prior CPA had them allocated all, say it was a $100,000 asset, so $20,000 a year, all the way down to zero. So it was depreciated to zero. So on the books, it's worth $0 after 5 years. We know that those types of vehicles and similar equipment will have some type of salvage value. And so utilizing that salvage value to not depreciating it all the way down to zero, because then if you're year 7 or 8, now you sell it for $20,000, now you got a huge $20,000 gain. And so depreciating it as much as you can, again, it's a big estimate, but as much as you can, down to what a reasonable value would be after 7, 10 years, or whatever that life of that asset is. So utilizing those, if you aren't already on new assets going forward, I would have you consider that. Talking about partners, we've thrown out a lot of these terms, and you guys obviously have good relationships, hopefully, with all of these guys. And if you don't, that's something to think about. Right? So having a bank to help your balance sheet be flexible, like we talked about, moving that line of credit down and terming that out, that's flexibility, right? Trying to massage that balance sheet in a way that benefits everyone. So if it's a line of credit that's really being used as a term loan, well, then let's call it a term loan. Let's change those docs. So having that relationship with the bank to do that. A good relationship with your bond agent and your surety. These guys are all on your team, right? They're trying to help you get the necessary bonds that you need for those contracts that you have coming up, and to help you, especially the bond agent, help you be presented in a good light to that surety. And so they're definitely on your side, as well as a CPA, having someone like we've mentioned with construction experience, and then any others, right? There's a few others that have, from an attorney standpoint, from contracts, testing, and writing, and assisting from contracts, from claims, lien releases, and then those types of partners that you have. So it's important to have that team with you. The other thing that we talk about is cash flow. Obviously, that's the most flexible thing we have, right? Is cash, being able to increase that cash, and you want that to be maximized and used properly. And so, from an inflow standpoint, a lot of times we hear that, oh, yep, we can't control when we get paid. But I would beg to differ, right? You can use your PMs to help you with your collections, right? They have a one-on-one relationship with your customers and general contractors or whatnot. So utilizing them in those collection efforts, and hey, what do you need? Let's make sure all the T's are crossed and the I's are dotted on our side to make sure that there's no hiccup when it goes through your payables department. Communication with your owners and GCs, having open communication with them related to billing practices and what they're required if they use Textura and those types of things online. And then just understanding the billing process and the requirements throughout the process. Then we've got the outflows, definitely taking advantage of the discounts. That's huge, right? It's a no-brainer. And taking on strategic debt. There is a place for corporate debt. There's from a personal standpoint, yeah, we try to avoid debt, but strategically for corporations, debt can be a good thing, right? It keeps cash in the company, and so you can finance that over a period of time to maximize cash throughout the next few years or whatever. And then obviously no lost jobs, making sure you're proactive on managing those contracts. Speaking of, so project management, holding those people accountable, your project managers, communication and documentation, and then communication and documentation, meaning with change orders, right? That's huge, right? So instead of handshake, yep, we agree with this, and then you go back and they're like, oh, we didn't talk about that change order. So if you have that conversation, if your PMs have that conversation, have them go back to their computers, back to their phone, email them, like, okay, this is what we talked about, just confirming it in writing in an email. Or let's make sure this change order gets done quickly and we can get signed and we can get documented and move forward so that there's no changes, no issues on the back end. And then direct labor costs, we'll get into that here real quick. A second here. So accountability real quick. So the one thing, when I've been meeting with clients, and I love to attend their project manager meetings, it is so apparent to me, and hopefully it is to you too, those of you that sit in those project manager meetings, which project managers know their job and which one doesn't. So think about that from the intangible standpoint of your surety. When he's asking you about these jobs, and you've had those conversations with your project managers directly because they're closer to those jobs, of course. And so when you respond, oh yeah, this is that job, this is what's going on. It's the same concept when you're meeting in those jobs, and I see it when I meet in those project manager meetings. It's so eye-opening to me. But oh yeah, project manager A, he didn't really know what was going on because he was like, oh, I don't know what that is. I'll have to look into that. Or this cost, oh, this doesn't look right. But then you go to project manager B, and she's like, oh yeah, this is why I got $10 on this, right? So going down to just a minute amount of money that they know, and they're on top of their jobs, and they know exactly, and those are the ones that you want to duplicate, right? Those are your project managers that, man, they know their job, they know exactly what they're doing. How can we have all of our project managers do that? And this is what I was talking about. I kind of got ahead of myself. So having those regular project manager meetings. I think I've had most of the clients that I've had that have really been on top of this have had monthly manager meetings. Sometimes you may have more than that. I think monthly is adequate depending on how quick of a turn your contracts are. But that's just making sure that you do regular project manager meetings and sitting down, letting them see those numbers, sharing that information with them, letting them come back and providing feedback on what on where they should be headed, where those contracts are going, so that they can see how the financial side runs those numbers through. Think about having incentive programs for those PMs, right? If you're, let's just use 20% margin, right? If you 20% margin is enough for the owner and the company to cover their overhead and enough of a risk reward to the owner at the end of the day, for him to have 10% of overhead and 5%, or then the remaining, I guess 10% would be for him or her at the end of the day from a return on investment. Well, if that 20% gross margin on those jobs is good enough for the company, well then if you incentivize your PMs or your team to say, hey, if we get up to 22% or 25%, we're share half of that difference above 20% with you. So in order to do that, you got to have good reporting, but just providing some option, because you know that you're good with 20%. So anything above that is awesome, right? You'd be happy to share a little bit of that with the people that were able to make that happen. Communication, we've talked about internal and external. Change orders, make sure those are in writing. Let's get into direct labor costs. So I've talked about this before in the past. Maybe you've heard me discuss these, but when we talk about inefficiencies and lost jobs, like that lost job that we talked about on that balance sheet, $50,000 provision for loss, that was probably caused by labor, right? Let's just get to it. It wasn't something that happened with materials. Oh shoot, we didn't order we ordered not enough materials, right? So now that cost was on us. That was our bad estimate. That usually doesn't happen. It's usually almost all the time on labor. And so this is just one example that maybe you can go back and start to use direct labor efficiency ratios. So I've got 4 jobs here. I've got a big one on the left here, job number 1, $10 million. So they had revenues of $10 million for that job. They have cost of revenues without direct labor and depreciation of 8.1. And so they had a gross profit margin without direct labor again of 1.8. So their direct labor though, to get that 1.8 was $931,000. So we divide the 1.8 of gross profit by the 931 and we get to $1.94. What that means, interpreted I guess, is for every dollar spent on direct labor, that $931,000, $1.94 is earned in gross profit, right? So the whole point, the whole goal is to maximize our direct labor efficiency ratio. So if we go to the job number 2 then, a smaller job, $1.5 million, and we have cost of revenues of just over $1 million, a gross profit of $442, direct labor of $191. Now our direct labor efficiency ratio is $2.32. So now we're going up. Now we've got a job number 3, $5 million. Now we've got a direct labor efficiency ratio of 2.7, right? So the whole goal is to maximize that direct labor efficiency ratio. easy, quick calculation does is it pulls out that direct labor, knowing that that's really the key to how to create positive jobs, minimize cost overruns, which is typically in labor, delays. You guys are out there for 2 weeks more instead of ending 2 weeks earlier. And so we're kind of using this table here and using the jobs that you do. The last thing I want to mention is, what is the sweet spot, right? What is your company's sweet spot? Where does your company hit it out of the park, right? I've seen a lot of companies that do great at $5 million, $10 million, even 30 or 40. When they try to jump up to that next level, if that's going from 10 to 20, if it's going from 50 to $100 million, are they making less money at that upper level, right? So did they make more money when they were at $10 million? They made $1 million, they made 10%, but then they go up to $20 million and they still made $1 million. Well, what's the point of increasing all that risk of doubling your volume, increasing your overhead, increasing your risk when all you're going to make is $1 million? If that's your sweet spot, then just stay at $10 million and make $1 million at $10 million, but try and maximize. We're going to stay at $1 million, but we're going to increase and find a way to squeeze all of that out of there and increase this margin based on direct labor efficiency ratios, the way that you look at your financials, to increase that from $1 million to $1.5 million or whatever. And so just leave you with that, knowing that where is your sweet spot, having the data to help you get to that point. What will it take to get you there? And so in summary, that's kind of the summary there. And so in looking ahead to the next 12 years, so bear with me here. So this is some thoughts, right? Maybe we'll come back in 12 years and I'll do this presentation again if I'm still around, and we'll see how close we got. So here's maybe what the new phone would look like, right? We had that original iPhone. Maybe it's going to be clear and all futuristic for us. Who's going to be the next president, right? We see Mark Cuban all over the place on Fox News. So he happens to be an IU alum, so potentially I could have a vote there. Who knows? Self-driving cars, those are more current than it seems. Those will be closer than we think, probably. And then the last one, I really hope this would happen. So if IU can get another championship for basketball, it's been a long time since we've had the last one, let alone the last 5. So that would be great. That would be amazing. So if there's any questions, I'm not sure, Stephanie, if I have access to the chat bar or the question bar. If you want to let me know what questions there are.
I'm not seeing any questions come in as of yet.
Okay. Well, as a reminder, if you guys can please put your name in that chat box so that Stephanie has information related to who attended. If you could put your name, just type your name in that chat box, just for attendance purposes, especially if you want CPE, so we can have record that you were here. We're trying to figure out another platform to get that, like with the national, if you're on national webinars, they have those check-in buttons that we have to click. We couldn't find that functionality here, so this is what we're going to do for now until we find a better solution. So
yeah, it's working. They're bringing in their names. Thank you, guys.
Okay.
I think Lisa's going to be closing out the program, and Jared, thank you.
You're on.
Thank you.
There you are.
I thought you were saying goodbye or something. Okay. All right. Thank you, Jared, very much. That was a wonderful, fantastic presentation. So I'm glad, although you didn't get to give it at the conference, I'm glad you got to give it here and we all got to listen to it. So thank you. And don't forget to remind me, we owe you some cookies. So, I should have had some cookies delivered. Usually we give away cookies, at the end of to our presenters. So we owe you. Okay. Anyway, so there's no other questions. Nobody has any questions for Jared or comments on that?
No, they're plugging in their names for me. I'm not seeing any questions come across. So.
Okay, well, awesome. Thank you again, everybody, for joining today. And thank you to Insurica for being our monthly lunch sponsor. That is a little something different that we've started this year, as we're not having any cost to our monthly programs. We are looking for monthly lunch sponsors. So if you're interested, please let the programs committee know. Lindsay Benson or Jessica Grant, you can email them. Also, be on the lookout. We're going to be having some other learning opportunities or programs coming out outside of the monthly luncheon. So we have one in July, I believe. That's going to be a webinar type GoToMeeting platform. And so we'll be offering a few more of those platforms for people just to make sure that we're, getting questions answered, giving everybody a platform to still connect and stay connected during this time until we can all meet again. So be on the lookout for those. And can't wait to see you guys all again. And thank you very much. Have a great day. See ya.
Thank you. Bye.